obviously it's pretty hard to value gold, but we're doing it based on our monetary factors. And we said in our base case scenario, conservative scenario, our price tag is $4,800 by the end of this decade, so 2030. And we're clearly above that interim target. That would be, I think, 2,900 by the end of this year. But we also have an alternative scenario where we say if inflation will be one of the main drivers for market in this decade, then up to $8,900 is actually possible. Now, 8,900 sounds like a big number, but that's actually a 19% CAGR from here until 2030. Now, gold is up 40% year to date. It was up, I think, 27% last year. So is 19% CAGR until 2030, is it impossible?
Gold and silver are at the heart of this shift, breaking out as trust in bonds and fiat-driven policy frameworks erodes. Ronald-Peter Stoeferle, managing partner at Incrementum, has long argued that we are living through a golden decade. His team's gold price model projects a base case target of $4,800 by 2030, with an interim milestone of around $2,900 by 2025 already surpassed. In an inflation-driven scenario, gold could climb as high as $8,900, a figure that may sound bold but equates to only a 19% compound annual growth rate, well within reach given gold's surge of 40% year-to-date after a 27% gain last year. From his perspective, the real stress is not in equities but in the bond market, which for decades formed the bedrock of portfolios during the Great Moderation. Now, with inflation volatility replacing stability, bonds have become the weak link while gold and silver have emerged as beneficiaries. Importantly, Stoeferle rejects the idea that gold undermines equities, noting both can perform in tandem, though U.S. tech valuations suggest bubble dynamics compared to value stocks, commodities, and emerging markets. At the same time, he warns that inflation's persistence is forcing central banks to abandon their stated frameworks, such as average inflation targeting, and pivot to new narratives and terminology whenever conditions deteriorate. This adaptive rhetoric underscores the fragility of the system while reinforcing gold and silver's role as anchors in an era where the rules are constantly rewritten. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
I think we're seeing another inflation wave basically building, and that obviously is the last thing that central banks want to see now. From my point of view, it is pretty obvious if we compare it, and there's a couple of great charts comparing the inflationary waves of the 1970s, for example, to the current wave. It looks pretty similar, although it's also some sort of chart crime happening sometimes. But then I think to some degree inflation is also a psychological thing. I would say it's not only a monetary thing, and I can tell you from my experience here, we're getting used to high inflation, because here 3 years ago a steak for like $60-70, I thought, okay, that's very high. Now I think, okay, yeah, gotta live with it. So I think that we are in the Western world, we're now getting more and more used to structurally higher inflation numbers, a little bit like in emerging markets, and therefore I think that another inflationary wave is definitely a possibility that the markets still seems to neglect. But they will probably come up with a new wording or whatever. I mean, I think it was interesting that they stopped this average inflation targeting that they introduced a while ago, where basically said as inflation numbers were too low for a certain period of time, they said, okay, we can let it overshoot, but now as inflation numbers were way too high, they would have to let it undershoot. But now they said, okay, let's forget about average inflation targeting, just stop doing that. So I think when you know what hits the fan, they become pretty creative with like new models, new terms, new abbreviations. Yeah, well, I just checked the numbers compared to 1 year ago at the conference. Gold was trading at 2,400. Yeah. Silver was, I think, 28, 29. The S&P was like 5,600. Bitcoin was 55,000. Yeah. So pretty decent performance in, let's say, sound money, kind of real assets. But if you have a look at bond markets, obviously, I mean, that's where the trouble is. And my take has always been, gold isn't the enemy of equity markets. Yeah, so I can clearly see, let's say, stable or higher equity markets and a positive environment for gold. I think the real potential is coming from fixed income, where we, as mentioned, seeing this complacency when it comes to inflation, because we've seen this great moderation. Basically, inflation was the least concern for asset allocators for 40 years. And now we are in this new inflationary paradigm where, let's say, not high inflation, but rather high inflation volatility is one of the primary concerns for constructing a portfolio. So from my point of view, if you have a look at equity markets, I mean, we've seen Oracle just recently coming out and the stock was up 30% on the data. Then we're seeing that Nvidia now has a higher market cap than the GDP of Germany. So all those things are obviously signs that the US tech isn't cheap anymore. However, if we have a look at in our portfolios, for example, we're still seeing very, very attractive valuations in the value space in Europe, in emerging markets, in commodity space. I think we're very, very active in the oil space at the moment. So I wouldn't say that per se the equity markets are super overvalued. It's just those, obviously those Max 7 stocks that everybody is so crazy about that clearly is in a bubble. But in general, I would say equity valuations are still, at least in the markets that we follow, at reasonable valuations. No, I mean, I have to slightly correct you. We have, in 2020, we came out and said it's going to be a golden decade. People were ridiculing us, and we presented our Incrementum gold price model, where we said gold there has to be a monetary valuation of gold. Obviously, it's pretty hard to value gold, but we're doing it based on our monetary factors. And we said in our base case scenario, conservative scenario, our price target is $4,800 by the end of this decade, so 2030. And we're clearly above that interim target. That would be, I think, 2,900 by the end of this year. But we also have an alternative scenario where we say if inflation will be one of the main drivers for market in this decade, then up to $8,900 is actually possible. Now, 8,900 sounds like a big number, but that's actually a 19% CAGR from here until 2030. Now, gold is up 40% year to date. It was up, I think, 27% last year.
Yes.
So is 19% CAGR until 2030, is it impossible? I would say no. But still, David, I think the most important thing is gold is in a bull market. And we've seen this big breakout from this consolidation phase, 2020 to 2024. And now we are like in a new stage of a bull market where every little dip is being bought. So that means that there's a tremendous amount of capital waiting on the sidelines. So many people, so many asset allocators that completely missed the gold party. And that's the reason why those corrections are so shallow.
Gold's role in the global financial system has undergone a dramatic transformation. Once dismissed during the Great Moderation, it is now embraced by central banks as a core reserve asset, with allocations at their highest levels in decades. This renewed legitimacy coincides with a shift in market dynamics. After gold's strong early lead in the decade, silver, mining stocks, and commodities are beginning to take the spotlight. Silver has started to outperform, mining equities have nearly doubled year-to-date, and commodities are steadily regaining strength, signaling the transition into the performance phase of the bull market. The underlying driver of this trend is the structurally rising demand from emerging markets such as China, India, Turkey, and the Middle East, an often overlooked but powerful force in shaping global flows. Building on this foundation, silver is positioned for explosive upside as the cycle matures. Historically more volatile and closely tied to gold's momentum, silver has the potential to reach triple digits in this bull market. The combination of strong emerging market demand, central bank accumulation, and shifting investor psychology sets the stage for both metals to play an increasingly dominant role as the decade progresses. Let's return to the interview.
Because I think you have to create a narrative, and I think this storytelling is important because we're all how much data can you actually, process? Yeah. So I think it's coming up with analogies, with pictures is an important thing. Last year we had the analogy from the world of professional wrestling with the heel turn, where I said that gold has been in this great moderation, has been something like the bad guy in wrestling. Yeah. And now there's this heel turn. So gold is in central bank spheres is becoming the good guy with, I think on average 26% allocation by the central banks, the highest in 30 years. Now this year, and this was also the title of the In Gold We Trust report this year, we said it's the big long, meaning that in the first half of this decade, we saw gold developing very, very well. However, we saw that silver, mining stocks, and also commodities were underperforming gold. And now we are in this new stage of a bull market where silver, gold, and silver mining stocks really start outperforming gold. And this usually happens like in the second half of a bull market, let's say like in the third part, or the third part of the uptrend of the bull market. And this is what we're exactly seeing now. If you have a look at relative charts, we can see that silver starts outperforming gold, although the gold-silver ratio is still at ridiculous levels at 88? But we're seeing that finally the mining stocks start outperforming gold, with the GDX being up, I think, almost 100% year to date. And we're seeing that slowly but surely that commodities also are picking up some momentum. So we compare it to the Tour de France, where you've got, if you ride in the peloton, you've got the guy in front, faces, of course, the most, is taking the most, wind, so that the wind pressure is the highest, and if you go in the middle of the peloton, you save energy. Right. But now gold has been kind of the guy at the front, but now it's the time for those sprinters picking up momentum. They have saved energy, and this is what we call the Haute moment, which is a part of the Tour de France. And I showed a video of Tadej Pogačar, who's like the superstar of cycling now, where he, on his really a ridiculous way up, very, very steep up, he just picks up momentum, and sets the pace, with an enormous amount of power. And this is what we're seeing now in what we call performance gold. So silver, gold stocks, and silver stocks finally starting to outperform gold. Not really. I would say the foundation of this bull market, and that was the topic of last year's In Gold We Trust report, the new gold playbook. We said the foundation of the bull market is this enormous, structurally growing demand from emerging markets. So not only China and India, but also Turkey, the Arabic markets, they are just becoming more and more important. And perhaps in the Western world, we're a little bit ignorant when it comes to this enormous amount of demand. So this is still, I would say, my base case, this kind of love trade for gold. But then we're seeing three additional drivers, which is first of all central bank demand. We are on track to see more than 1,000 tons of gold central bank purchasing for the fourth year in a row. So that's significant demand. And this will continue based on the World Gold Council survey. The second driver from my point of view is this kind of erosion of trust that we're seeing. So if you have a look at, for example, COMEX deliverers, it seems that people now really want to get the real stuff instead of paper contracts. And we're seeing this trust erosion, in so many pockets of our lives, be it in science, in politics, in the media, and also in institutions, and also in, I would say, like the gold market, where people say, okay, well, if it gets tougher, I really want to have the physical gold and not a paper contract. So that's the second trend. And the third trend that we're seeing is obviously this kind of de-dollarization, which has been a major driver going on, with basically the world breaking apart into two blocks. And just recently we saw this Shanghai Cooperation Organization meeting, and if you look at the symbolic character of those pictures with Xi Jinping, with Modi, and with Vladimir Putin, it seems that they're pretty good friends, and that they will try everything to kind of build an alternative system. So gold is a neutral, non-inflatable reserve asset, and I think it always held that role basically, but now it's really celebrating a renaissance. Yes, I mean it's we are running two funds that combine gold and Bitcoin, so we are in both camps. We're in the sound money camp. I just can tell you, bless you,
thank you,
that the sentiment in the Bitcoin space is. It doesn't feel like that we're very close to new all-time highs. Actually, yeah, it's kind of a neutral
That's
sentiment,
right.
yeah, which is a very positive setup from my point of view. So I think there's still way to go. I think that the combination of gold and Bitcoin is now something that's resonating more broadly. We launched the first fund more than 5 years ago. Now we saw Cantor Fitzgerald coming out with a gold Bitcoin product. There was Tether Gold. I had a very interesting conversation yesterday.
Right.
So I think more and more people are realizing that the combination makes sense. And I also know from many people, let's say younger people in the Bitcoin industry, the older, you're a young man, but the older you get, the more conservative you become. And I know many Bitcoin millionaires, perhaps even billionaires, yeah. The older they get, the more conservative they become, and the more interesting gold becomes for them, because perhaps they don't want to deal with this enormous amount of volatility in Bitcoin anymore. So I think it's really now going both directions, from gold to Bitcoin, but also from Bitcoin to gold. Triple digits at some point.
Yes.
Yeah, within this bull market of gold.
Gold and silver stand at the center of a powerful structural shift fueled by persistent inflation waves, central bank demand, and rising distrust in paper assets. The foundation lies in the relentless appetite from emerging markets, while additional momentum comes from de-dollarization and the revaluation of gold as a neutral reserve asset. Having broken out of years of consolidation, gold has entered a new phase of its bull market where every dip is quickly absorbed evidence of capital still waiting on the sidelines. Silver, miners, and commodities are now beginning to outperform, signaling the performance stage of the cycle where volatility translates into outsized gains. With shallow corrections, steadily rising demand, and the likelihood of silver ultimately reaching triple digits, both metals are positioned not only as hedges against systemic fragility but also as leading beneficiaries of a monetary era in transition. How high can gold and silver climb relative to equities and bonds by the end of this decade? So stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.